One of the most common questions I get from investors has absolutely nothing to do with a good investment. By the end of this video, you'll know exactly why low price doesn't equal a good stock pick, and 3 strategies you can use to find great investments. We're talking investing strategy today on Let's Talk Money. Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in our community. Thank you for taking a part of your day to be with us. If you're not part of that community yet, just click on that little red subscribe button. It's free and you'll never miss an episode. One of my favorite subjects is talking about investing myths you hear on the internet. Now, from the ridiculous to the just plain bad advice, it's no wonder the average investor earns less than 4% a year, according to researcher Dalbar. That's why I decided to put this video together in partnership with The Motley Fool to bust through one of the biggest investing myths I see. Now, one of the most common questions I get from investors is, what are the best stocks with low share prices? The question makes me die just a little inside, but I understand the reasoning. Let's look first at why share price means absolutely nothing. Then I'll reveal 2 solid stock picking strategies. I'll also share 2 stock picks under $50 that aren't just priced cheap, but are great investments as well. First though, I want to hear the craziest investing myth or stock advice you've ever heard. What's the worst bad advice you've gotten for investing? So scroll down and tell us in the comments below the video. Now let's look at a tale of 2 stocks. You could pick up shares of our first mystery retailer for just $8 a share. Own a piece of an international company for less than the price of a venti mochaccino. By comparison, it would cost you over $1,800 a share for our other mystery retailer. So it's either one single share or about 400 Beanie Babies. That first stock was Build-A-Bear Workshops, down 20% in the last year and underperforming the S&P 500 by more than 30%. While our second mystery stock is Amazon with an astounding 75% return over the last 12 months, blowing the doors off the broader market. The price of a company's shares depends on just 2 things, neither of which has anything to do with value. First is the market value of the company, its market capitalization. The second is the number of shares a company has issued. There's no difference for a company in having 1 million shares on the market or 10 million shares. Netflix is a $172 billion company with about 434 million shares issued for about a $400 per share price. If Netflix were like Microsoft with its 7.7 billion shares issued, the shares would be priced at about $22.40 each, but it would still be exactly the same company. So if stock price has nothing to do with a good investment, what are some strategies you can use to find great stocks? Now, I'll cover my 2 favorite stock picking strategies first, and then share 2 stocks I'm looking at for my own portfolio. First, let's look at growth investing, which is finding companies with the potential to grow earnings faster, usually based on competitive advantages and industry growth. This is actually the subject of an entire video I did last week where I shared a stock screen and 4 characteristics I use to find solid growth stocks. I'll leave a link to that video in the description below if you want to go deeper into growth investing. The easiest way to start your growth investing strategy is to look for companies that have outperformed in the past with strong earnings and sales growth. Then you can look through this list to find companies with a competitive advantage that are going to continue that outperformance. Whenever I'm looking to add stocks to my growth portfolio, I'll start with the stock screener on the Motley Fool. I'll toggle high and positive conviction here, which narrows the list to stocks with a high degree of confidence in the upside. I'll usually check for small and mid-cap under asset class to narrow this list to companies with under 10 billion in size. Now, that's not a hard fast rule, but it gets harder for companies to keep up that higher growth rates when they get into the hundreds of billions in size. Finally, I'll toggle on this 25% and 50% above for revenue growth. That's going to start me with a short list of stocks here, potential growth investments that I can research further. Within this short list, I'm looking for companies with farther to run on industry growth and advantages over other competitors. Our next strategy is what most investors think of as the opposite of growth investing, but you're still looking for a lot of the same characteristics. Value investing is finding stocks that trade below their true worth based on fundamentals or compared to peers. When looking for value stocks, most investors start with basic measures like price to earnings ratio or price to sales. By comparing this to the ratio for competitors, you get a sense of which stocks are relatively cheaper. Now, of course, cheap doesn't equal good, so you have to look further into these stocks to see if the shares should be priced higher or if there's a reason they're cheaper. A lot of times, good companies will get hit with bad news that might temporarily send share prices lower. So using this value investing strategy, you can get in on the deal before the stock price rebounds. Just as with growth stocks, I'm fundamentally looking for strong companies with good management that have some kind of an advantage over peers that's worth more than is priced into the stock. Now, those are two core investing strategies, but I do understand one reason why that low share price myth persists. With most online investing platforms, you can only buy whole shares. That means you'll need at least $1,800 in your account to buy that one share of Amazon. That might be possible, but even a $10,000 portfolio would mean 20% of it is in one stock. On the other hand, you could pick up a few hundred shares of Build-A-Bear and only have a small part of your wealth in the stock. So to help in finding good investments that also happen to be lower priced, the Motley Fool has released a special report. It's 5 favorite stocks for under $50 a share. I looked through the report to pick out my 2 favorites using the investing strategies above. Kinder Morgan is one of my favorite high-yield stocks in the energy space. The company owns pipelines and storage facilities for oil and gas, connecting oil fields to refiners and charging a fee on the transportation. Now, this means revenue isn't directly tied to the price of oil or gas because the company sets its long-term contracts for the amount that goes through the pipelines. The company also owns some oil production, so it's a little more vertically integrated compared to other midstream pipeline companies. Like a lot of companies in energy, Kinder Morgan had a rough 2015 after that drop in oil prices. While sales don't move one for one with energy prices, it still hurts when the price of oil falls from $100 to $20 a barrel in less than a year. Kinder slashed its dividend to protect cash flow, shifted to internal funding, and focused on efficiency. The great news for new investors is that the share price has stabilized. It pays a 4.4% dividend yield, and management believes it can return to dividend increases this year. Rollins is a best-of-breed pest control company with business on every continent except Antarctica. What I love about Rollins is its predictability. The company gets about equal sales from residential and commercial customers, which gives it business cycle safety. More than 80% of its business is recurring from existing customers. Rollins has reported 18 years of uninterrupted earnings growth and 12% annual dividend increases for 16 years. The company has over $107 million in balance sheet cash and no long-term debt, giving it a lot of financial flexibility. There are a lot of investing myths like stocks with a low price. Seeing through these myths and understanding the strategies to find great investments is going to put you on track to beat your goals. Check out that stock screener on the Motley Fool to get you started. I'll leave a link in the video description below, and don't forget to share the worst investing advice you've ever heard in the comments below. We're here Mondays and Wednesdays with the best videos on beating debt, making more money, and making your money work for you. If you've got a question about money or investing, just scroll down and ask it in the comments, and we'll answer it in a future video.